We're back.
Hello.
Hello.
Oh, we're back. Oh, sorry, you caught me off guard. Welcome back, everyone, to In Your Best Interest Malaysia edition. We are live, and for today's big topic, I think it's something that's on everyone's mind.
Yep.
Minds, even if you're an investor or you're not an investor. It's the Iran-Israel conflict. So we are going to get into that, but we wanted to talk about it, from an investor's perspective.
Yeah.
How does it really matter to the economy, to the markets,
What
etc.?
does it mean for your portfolio?
What does it
How do you
mean
think
for
about
your
these
portfolio? Yeah, but before we get into that, let me just get this stream on my phone. Okay.
things? My name is Ken. I'm the country manager of
Yeah.
StashAway. And this is Imran. He works here. I
I
don't
did.
really know what he does. He does a lot, actually.
I also don't know what I do here, but no. So yes, I'm Imran. I'm the financial writer here at StashAway.
And the face of our socials.
Sometimes, not all the time, but sometimes. So yes, before we get into it, I want to give the disclaimer, as always, that this is not financial advice. You can think of it as simply a weekly guide, a monthly guide to the markets, right? And because my job here is really to break down these sort of things for investors. Okay, so let's get into it with our first segment. Okay, I got it here now, Ken. So let's get into our first segment, Invested, and we'll talk about the Iran-Israel conflict. So Ken, you wanted to give a little bit of a background into what's happening with the market at the moment?
Yeah, so I know that everyone is rightly concerned and probably have seen a lot on social media about this current conflict, but where we come from is we're not geopolitical experts, we're not weapons experts. We are here to try and see what's happening with financial markets and relay to you what it means for your portfolio and how we think you should respond to all of this. Why it is, I guess why it has been ratcheted up quite a lot is because this conflict has dragged the US into it as well.
Yeah.
You know that that President Trump sent US bombers to essentially bomb these uranium enrichment sites. So that essentially brings on more uncertainty, especially if it escalates.
Yes, so it's about like whether the US will be involved further, and if it escalates outside of the region as well.
Yeah.
Okay.
If it, for example, disrupts oil supply,
Yes.
oil is now at $72 a barrel.
Yeah.
The state of Hormuz, I think you wanted to say a few things about that.
Yeah. So actually, of course, it's a developing situation, right? It's happening right now, and in fact, we will be having a video out from our CIO on this topic. So and our outlook for the market in general. So you can look forward to that on our social media as well. Okay, but talking specifically about what happened in the markets, well, basically the main point here is the oil prices, right?
Yep.
And we're looking at the Strait of Hormuz, which is where about 1/5 of the world's oil supply goes through. So if the conflict escalates and there's disruption in that area, then you'll see an impact on inflation. And sorry, yeah. Oh, wait, sorry guys, we have live technical issues.
Not strong or not turned on?
I think the
Don't worry guys.
Okay.
Hi to Bellamy as well in chat.
Wow.
Yeah.
Okay.
Okay, sorry. So let me just start again very quickly. So how does it matter to investors and the markets? It's about oil. And I have some statistics here actually. So let's say if oil prices are $75 now, Brent crude oil, that's the benchmark, that would increase gas prices by around 12% approximately. And if you increase gas prices, then you talk about transportation prices, and then it just affects goods in general, right? So that's what you're talking about, inflation, and
Yeah.
that's how it affects the economy. Okay, but also I was doing a little bit more research, and I found that there's some sort of a historical pattern when it comes to geopolitical shocks like this. So Deutsche Bank, they looked into it, and typically you see around a 5% pullback in markets for the S&P 500, but it recovers around 3 weeks later. So it's always there's the shock, and then as the market start to digest what's happening, and if the market sees things being largely contained, then it just recovers again, right? And it's a historical pattern, right? So, I mean, history is one thing, right? You shouldn't base fully on history as well, but it can be a little bit of a guide, right? So yeah, that's what we are looking at for the impact of this event. So hopefully things remain contained, Ken.
Yep. I think what we also saw was gold reacted. Gold is a safe haven. I think we all know that gold has had a very good year and a half. In 2024, it was up 26%. This year to date, it's only halfway through the year and it's already up 26% again. So it's really about the proxy to uncertainty, and this adds further uncertainty to that. But as it relates to conflict, like this current one between Israel and Iran, the 2022 Russia-Ukraine conflict, and also the Hamas attack on Israel in October 2023, gold tends to spike and maintain elevation in a few weeks after a conflict like this. So after those 3 conflicts, on average, gold is up around 6%. So we've been talking a lot about gold, and it should be a core part of your portfolios. It's also a core part of the general investing portfolios. I think that's the reason why gold is there in the first place.
Yes, and so talking about general investing, right? Our portfolio, I think that's okay. If you want to be a little bit defensive, right? If you feel nervous about what's happening, you can create a portfolio that is defensive, right? You can lower your risk, right? You can increase exposure to things like gold, right? And by the way, all of this is of course available on our app. You can do it yourself with flexible portfolios, but in general, for our general investing portfolios, as Ken said, gold is built into it, right? So I think that's a good way to look at things, so you can be defensive and still be invested at the same time.
Yeah, just taking a step back, we've seen so much in the last 6-7 months, right? We've seen Donald Trump come into office. We've seen DeepSeek really blow up the tech space. The Israel, the Israel-Iran current conflict. There's always something that affects broadly, markets in particular, or the trade temper tantrums, of course.
Oh yeah,
in April, how could I forget? And there's always something that gets hit, right? So, like what you said, you should play defense with the way you diversify, right? You diversify away from the tariffs by investing in, let's say, the other equity markets around the world, as opposed to just the US. You have some gold in case of conflicts like this. You have other sectors and not just tech in case of something that happens to AI. So by just being diversified, you're already playing defense with your wealth.
Yeah, and to me, this is the way I think about building a portfolio. Really, when you have all these assets, right? Because I don't know, maybe I'll share something personal about myself. I play video games, Ken.
Oh, I find it very hard to believe. I thought you were a fitness influencer or something like that.
No, I'm not. So I play video games, and it's like building a team in that video game, right? You want somebody who can deal that damage up front, take on a little bit of that risk, right? But you also want that tank, right? Somebody who can take a little bit of damage as well. So that's how I view things, and it's
not the healer.
And then you got a healer.
Yeah, you got the healer.
So I think about it in that way. It can be quite fun also. Okay, talking about general investing, Ken, why don't we move to our new segment for this month and probably all months moving forward. We are calling this segment Performance Monthly.
Have we confirmed that, or I thought we wanted to call it report card or something like that?
Okay, we'll talk about the name.
Yeah, production meeting aside.
Yeah, we have a meeting. But essentially, we just want to share
Yeah.
our performance with you guys watching live on a monthly basis. Specifically, how our general investing portfolios have been doing.
Yeah. So on the, we have two kinds of sets of returns for you, and there's a few numbers coming your way. So in US dollar terms, because our general investing portfolios is denominated in US dollars, the range of returns range from 4.2 to 8.1. So very good kind of returns on the surface. But of course, we here as Malaysians, we see things in ringgit. When we withdraw, it's in ringgit. So in this year so far, we have returned negative 0.9 to 2.8%. So I'll say again, negative 0.9 to 2.8% year to date. In March, the returns are negative 0.9 to 3%, the range. So you can see that the US dollar returns are elevated compared to the ringgit returns. And really, this is something that we'll get into in the next segment.
Yes.
But just to kind of address that, you can see that in May and in April as well, you saw a 6% appreciation of ringgit against USD. And this is because of the temper tantrums from trade, the trade wars.
Is this general move away from US?
Yes, there's a erosion of US exceptionalism.
That's affected the dollar.
Affected the dollar, equities, and bonds. So in essence, what we're also trying to say here is that moving forward, the US dollar may not also provide such stellar returns like it has in the past. But I'll contextualize all of those FX returns and commentary in our last segment.
Yes.
Yeah.
And
And just to also say that that when you invest in GI, of course it's denominated in USD, but you're investing in a basket of currencies because of all the effective exposure that you take through, say, just very simply, if there's a Asia ETF in the mix, the Asian ETF comprises of many different Asian currencies. If there's Euro one in there, they're exposed to the Euro. But it's just denominated in US dollars. So the effective US exposure is not the whole thing.
Yes. So there's a difference between the ETF being denominated in the USD and the actual USD exposure. But so I won't get into it so detailed here, but a simple way to think about it, for example, Microsoft, right? US company. It's in the US denominated ETF, USD denominated ETF. But Microsoft itself generates 51% of its revenues internationally. So how much is it really exposed to the US and the US dollar, right? That's one way to think about it.
Yeah.
Because after all, when you're investing in businesses, and more often than not, these businesses are multinational and very global. Okay, and now we'll get into the real meat of talking about currency fluctuations, because we go into the next segment, which is Real Talk. Are you ready for the next segment?
I hope so.
So this segment usually is my favorite segment as well, because Real Talk is where I go into the Malaysian PF subreddit and I find what people are talking about, real Malaysians. So today's this month's question I've chosen: how do you deal with the psychology of converting ringgit to USD for investing? Exactly what we were talking about with USD denominated assets. There's this stress of waiting for better rates or worrying that the ringgit strengthens and that diminishes the gains in USD, right?
Yeah.
So what would you first say to that, Ken?
I would say first is to recognize that there is this risk in the first place.
Yeah.
You would have to think of it as an additional risk in terms of your overseas investments. It's something you don't have to think about when you're investing in Malaysia, in a Malaysian company, on Bursa Malaysia, for example. But if you wanted to stock pick and choose NVIDIA, if you wanted to buy an index like the S&P, you have to lay over FX risk as well. And we like to think that we keep everyone involved when we think about global diversification, when we talk about investing internationally. We cover the risks that come with it. We don't just hype up returns.
Yeah.
So the first thing is recognizing that there is this risk. And the second thing is to understand this risk. The understanding comes from, we touched on it a bit earlier, but there is a difference between denomination and exposure. Denomination is just what the price tag is of the underlying ETFs. So if the S&P ETF is quoted in US dollars, that's what we mean by USD denomination. And the whole portfolio, whether it's listed in different exchanges, is all USD denominated. So when you toggle between USD returns and ringgit, it's taking into account all in all the effective exposure you have towards international markets. So it doesn't just mean that, the difference, the total difference, it relates 100% towards USD and ringgit. It's only partial. In certain portfolios, the USD exposure is higher, but in some, it's a little bit more diversified. So what you're investing in when it comes to GI, general investing, is a basket of currencies. So that's the difference, denomination and exposure. So let's look at recent events. In this year, the ringgit has strengthened to the dollar by 4%. So if, let's say, you invested in our StashAway portfolios and in USD returns, it's something around 4%, what you're likely going to get is less than that, because the underlying, this year has been flat in terms of S&P, in terms of markets. And then you minus 4 from that, from the USD exposure and the other currencies, so you would get less than that. But if you look at a slightly longer time frame, you would see that ringgit tends to weaken against a lot of major currencies, including the US. In the last 10 years, from today, the last 10 years, the USD has appreciated 10% against the ringgit. It might not seem like a lot, but actually it's because the ringgit has strengthened a lot in this year. And if you looked at between period of time, let's say 2013 to 2024, which is very recent, just last year, the dollar appreciated 60% against ringgit. And that's why last year we introduced USD cash yield as a portfolio, because dollar was going to ringgit around 4.8% with a risk of going higher. A lot has happened since then. USD kind of dominance and US exceptionalism is eroding. A lot of it has to do with the trade tariffs that were introduced in April on Liberation Day. Because of that, a lot of countries have to look at their supply chain, they have to look at different markets, they'll look at different trade partners, and because of that, there's talk about de-dollarization, there's talk about diversifying your trading partners, and so the shine off of USD going forward is in doubt and in question. So we think that international investing is still the way to go. Home bias is a real thing. A lot of people just stay invested in Malaysia, but overseas markets has proven consistently to have better risk return. And if anything, you want to diversify away from just Malaysia. So you have to also recognize and understand and ultimately accept the risks of investing abroad, which comes with FX risk. So having said all that, if you look at the general investing returns that we have posted in not just this year, but the years before, FX has helped in those cases. And you will have these fluctuations where it helps and it doesn't help. And ultimately, you have to balance it out through diversification and also dollar cost averaging. This long-term perspective really does take into account these ebbs and flows. There will be times where it doesn't help, like now. There are times where it massively contributes, like I said, between 2013 and 2024. So we always come back to this: stay focused, stay invested for the long term, and these currency movements is no different.
Yeah, I mean, actually I had some of the similar points here, but you already covered it, so thanks, Ken.
And then
hold on, wait, I do have my own point.
Okay.
So I told Ken I had something to blow his mind. Hopefully, here I go. Okay, guys. So as Ken was saying, if you are a little bit worried about what's happening, I guess to summarize everything that's happening right now, right? Because that's my job, right? Every week I put out emails about what's happening in the markets, right? So in the moment when you are facing volatility, turbulence, fluctuations, even with all sorts of things, I think it feels apocalyptic in the moment, right? Always. And it's true. And the headlines are scary and the volatility is real, right? But you just got to zoom out. And here's why you got to zoom out. Okay, I'll show you guys. I've teased it enough. Look at the USD ringgit exchange rate now. What is it, Ken? 4.29.
Yeah.
4.29.
Yeah.
What was the USD ringgit exchange rate 5 years ago? Any guesses?
4.4, 4.5.
4.29.
So 5 years ago,
Exactly the same. 5 years ago until now, it's exactly the same. I'm not
Is
even,
that the
no, I'm not even
Oh, you're
done
not
yet.
that. Okay, I'll take that back.
So if the USD to ringgit has not changed exchange rate wise in
Yeah,
5
in 5
years,
years.
what happens if you put that money in the S&P 500?
Ooh.
What is the change for the S&P 500 over the past 5 years?
Should be 20+% returns last few years. So I would say on average 20% plus returns.
Exactly, you pretty much hit it because 5 years ago until now, 98%.
Cumulative returns, right? Yeah.
Yeah. So there you go. I don't think I need to say anymore, right?
Wow.
So
Case closed.
case closed. So your exchange rate 5 years ago is the same,
Yeah.
but if you invested it, it's 98% returns, right? Difference. So my point is, the bottom line, it's probably more important just to focus on getting your money to work in the markets
Yep.
rather than trying to game the exchange rates or just worrying about what's going to happen. Right?
Really, really good point. And something our CIO, Stephanie, said about currencies as well, there's always some sort of mean reversion.
Yes.
Whether there is a 5-year cycle or 3-year cycle or whatever it may be, there's always a reversion to the mean. So that's a really good point because you choose to invest in something like the S&P or let's say Chinese tech or let's say gold, right? Based on the underlying currency. Based on the underlying asset class.
Yeah.
It shouldn't really be about the FX. The FX is just more of a small tailwind or a small headwind. It's just the cost of doing business and an additional risk when you invest globally.
It's the underlying asset, really. To
Amazing.
me, but of course, I think that will be the end of this show for today. Thank you all for watching. We'll be happy to see you all next month. And next month, we will also continue to share our portfolio performance. So that will be the new segment for everyone. So once again, thank you guys for watching.